What's up, everybody? Welcome to another edition of Zach's Live Trader. Here with you as always, I am the bearded boy wonder, Dave Bartosiak, and today, my friends, we're talking a little smack about a company you may have heard of, Apple, AAPL. I'm going to wait just a few seconds, let these folks trickle on in, and then we'll go ahead and get started. And this is my new thing here, guys. I'm going to be rocking the Pandora at all times, all the times, because really you need a good soundtrack to trade to anyway. I hope you guys aren't sitting in silence and, you're rocking and rolling. So Apple's going to report, I believe, tonight. So I wanted to get this out to you. I know it's kind of a strange time, this 11 o'clock, but that's what we got going on. And we're going to do this the day of. Tomorrow, we're going to do Tesla the day of. Wednesday, we're going to do Applied Optoelectronics, AAOI, which everybody's been clamoring about. I am trying to get a special guest to show up with me, but we'll see. I'm going to try and wrestle Mr. Brian Bolin to do it with me. We've never done kind of two people on one video, so I'm not sure about that. But I'm going to tweak it. There's some settings in YouTube. I can add two cameras. We probably don't want to see his ugly mug, though, so we're going to keep it just so we can hear him. I don't know. We'll figure it out. It should be fun. So that's going to come up on Wednesday. Thursday, of course, the GBU weekly trade review. And then Friday morning, we'll do the morning after because we will have Applied Optoelectronics reporting Thursday after the bell, which should set up a nice Friday. So that's my agenda. Good morning, PJ, Kurt, Trevor, AJ, Dr. Paul, and Miguel. How you doing? Welcome. All right, guys, you know the drill. There's a little bit of a delay between me saying it and you hearing it. So don't feel bad if you type anything and it takes me a while to respond to it. It's just we got a little lag here. All right, let's kick things off. As always, the price consensus EPS surprise chart. Black line corresponds to the right y-axis, which is price. The multicolored lines represent the evolution of our Zach's consensus estimates, and those coincide with the left y-axis, which is EPS. The red arrows are earnings misses. The green arrows, earnings beats. What do we know about Apple here? Well, we've got a string, 2, 3, 4 beats in a row here for Apple, so a little bit of momentum here. I like the overall trajectory of these EPS estimates. Look how nicely those kind of carve and move with the price. It's just epic. But here is the issue. Do you guys see this disconnect between Apple's price going here and this EPS going sideways? I sure do. Now, there is a little bit of a delay, so to speak, right? So this seems to kind of front run, right? The turn in the corner to the downside after a plateau. It takes a little bit, so price kind of moves first. So what you would expect here on this sort of curve is these estimates to come up because price is already gone. So you're expecting EPS, and that's why people have run up the price, because they're expecting these earnings to go ahead and turn up. So that tells you a little bit about the expectation heading into this report. We're looking for some sunshine and lollipops out to the future. Now remember, we do have a new iPhone cycle that's going to be coming on, so hopefully that will be enough to push this thing in the right direction. So that's essentially what we're looking for. So just off this price consensus EPS surprise chart, you can see what the recent momentum has been, and you can see what the expectations are. So people are looking for some good news here out of Apple, all right? Now let's look at the detailed estimates page, give you some more perspective. Now this is a Zach's rank number 3 hold. That's what, I don't know that I've ever seen Apple not be a 3. Just a huge company. Oh, they're after the bell tomorrow. Why did I think they're after the bell today? I don't know. I thought they're after the bell today. I'm losing it. So they're after the bell tomorrow. So we have the rest of the trading day today and tomorrow to take care of business. Looking down here at the revenue side of things. Current quarter just looks like 5.5% revenue growth. Next quarter, 4.9%. That rounds out the current year at 425, but next year, like I said, new phone, new cycle, 13.85%. So people are going to be looking forward towards next year. However, the current year, we got another quarter until we round that out, so I don't know that they're going to be looking that far. If you look at the EPS side of things, looking for 10% growth this quarter. Next quarter looks like 817. Current year, 679. Next year's numbers look a lot better, 20% growth. Again, are people going to be that far-sighted? Not sure. Looking recently, now here's why it's a 3. You always have a little bit of infighting amongst the analysts. So over the course of the last week, 2 analysts have dropped their earnings estimates for next quarter and the current year. Now you flip that to the opposite side, and you do have an analyst that has come out and increased their estimates for the current quarter and next year. So it's an interesting sort of argument these people are having. And then, of course, in the last 60 days, you have 7 analysts who have increased their next year numbers. The current year, they've dropped them. So the overall effect to our Zacks consensus estimates, you'll see here, kind of stagnant. 189 down to 181, 894 to 887, but 1035 up to 1074 next year. But still, remember we were talking about in our price consensus EPS surprise chart, we're looking for a little bit more of a ramp up there, I think. And we're not really seeing that here. The recent surprises haven't been that surprising. 4%, 60 bips, 2%. So nothing spectacular, but that's what you'd expect for a large company like Apple. There's a lot of analysts following it. They have very mature models that they've developed over an extended period of time. So you don't expect to see huge surprises to the upside or the downside, but beats are good nonetheless, okay? And they are coming off of 4 beats in a row. The chart, what a healthy 2016 into the first quarter of 2017. Pretty spectacular. Topped out in March of this year, and it's been not that wide of a range, but $1.42 to $1.57 basically. It's been the range, and we're kind of smack dab in the middle of this range. So if we were closer to the top of this range, I'd expect a breakout, or closer to the bottom of the range, you'd expect a breakout. But when it's kind of smack dab in the middle of a consolidation range heading into earnings, it's really going to take some heavy lifting to break these guys out above this level or down below this level. So it used to be as goes Apple, so goes the NASDAQ. Well, that really hasn't been the case. As the NASDAQ's been breaking up to new highs, of course, last several sessions have been a little rocky, but you see what I'm saying. We're still kind of stuck in the middle consolidation range on Apple, and the 50-day is basically horizontal, and we're at it. So this is just screaming range-bound consolidation range trading. So waiting to buy dips to 142, looking for a breakout above the all-time highs. Those are kind of the 2 ways you should be looking at this. On my ZRS here, we could see this is the EPS, and 2016 was kind of a rough year, but always looking forward is what Apple was doing. So they're still looking for 7.3% growth this quarter, this year rather. Next year looks like 20. So the question is, have we gotten out ahead of these 2018 expectations too much on Apple? And I think that's what you got to ask yourself. That's the EPS side. Let's look at the revenue side of the equation. And you'll see here, similar story where 2016 is kind of a dud, 2017 is an in-betweener, and then 2018 is when things are really supposed to open up and get a lot better for the company. So are you looking out to 2018, and are you comfortable with paying for 2018? See what these guys have done. Well, actually, no, I don't care about that. Let's go. Let's go to the consolidated surprise chart here. See how they've reacted previous earnings reports. Stagnant, 5.8%. Virtually stagnant, 5.7%. Here's a 6.96%. So there have been some moves historically, of course, with Apple. But the last time these guys moved 7%, December 2013. So I certainly would expect something shy of that. I bet you the market's pricing in a little. The market's probably pricing in a low move. And that's what we're going to find out when we take a look at this options chain. So let's look. Here I am on bar chart, just the front week. Man, it's going to be a fun week. Let's make this the side-by-side view instead of the stacked view. We're going to take a look at the 140. It's 148.65. Let's look at the 149s, get an idea of our implied volatility here while we're rocking out to Ozzy Osbourne here. 260 by 263. Let's call that 262. The at-the-money puts trading 295 by 299. We'll call that 297. 559 is the move they're expecting out of Apple at $1.49, 3.75%. So I'm going to go out on a limb here and say this is kind of low. You guys are going to like this because I wanted to detail a little bit more of the logic. I've been getting some emails from people asking me to explain myself a little bit further when I'm looking at especially the credit on these the credit side of things. So a big question I get asked a lot is, Dave, why are you looking at iron condors rather than the strangle, right? So instead of selling the at-the-money call and the at-the-money put, pocketing this 559 and just hoping that it doesn't move as much, why are you looking at the condor? The reason being the skew. So here I'm going to draw like a normal distribution kind of, right? So here's the at-the-money strike, the 149, okay? And then let's say, you know, if you want to be fancy, you call it sigma, right? One standard deviation out to either side. And then let's call this, I'm defining this sigma right now. That's right, I get to do it. It's my show. I'm going to define that as the IV, the implied volatility of this move. So I'm going to say it's 550, right? 559 to either side. So plus 559 or minus 559 from this level, right? So basically what I say is the options market is expecting this stock to stay within, and I'm using sigma, that's for standard deviation. Obviously the IV is not equal to standard deviation, but again, my show, just bear with me. So the odds of, you know, the market staying within these parameters are pretty high, right? So there's that, okay? And then so normally there would be, you know, the premium for these strikes is going to be more, right? And then it'll drop off. So on the call side and the put side, it would drop off, right? So let's say that's the normalized way, okay? So let's say normally it looks like this, but I'm seeing it look more like this. So there's the skew. So while these numbers are going to be the same at the 149, I think that just going out to each side by that 559 isn't really representative of what the market looks like. And that I'm getting paid way more here than I should be. I'm going to do this one more time to illustrate this. I'm going to make it more dramatic. Okay? You guys know what I mean. So here's the middle. God, you guys got to be cracking up about this. I can't draw a straight line to save my life. 149 is in the middle here, okay? Right? And then this is what the options market is, in fact, pricing. So this is our sigma of it, right? And negative sigma. And the skew is just flatter out, right? It's flatter out longer. So I'm basically looking at these and saying, in the in-between, I think they're pricing it a little bit too high, and in actuality, I think it should be closer to this curve. So essentially what I'm doing is I'm saying, no, options market, you're getting it a little bit wrong, and I'm adapting my model based on my assumptions. Yes, that was a lot to take in there on a Monday morning. Drink of water from a fire hose. I will go back on that subject, and we can talk about it further in the future. I just wanted to give you a quick little overview of what I look at. So what I'm saying in plain English is that going out this 550, I might not be getting rewarded enough for my risk. But if I go out a little further, then I think I'm getting more bang for my buck, because the skew is different. I think they're putting too much money in the middle and not enough further out. And one of the things that's making that happen is our friend the VIX. With the VIX at 10, we're not getting enough volatility priced in at the money here, okay, on either side. But if I don't believe that the stock is going to move a lot, okay, then I still want to do a credit spread, kind of go out on either side. But where I'm going to go on that curve is where I'm more comfortable, which is the further out on the flatter curve. That's the math behind why I'm looking at condors. Okay? All right. So let's look at this. So already, guys, I want to do our little trending analysis, right? So pretty sideways, nice trend, okay trend. So you notice the trending as the EPS is trending. When EPS starts to level off and come down, some choppiness. And then some trending. Stock is trending, choppiness, boom. So this is what I think is going to happen here with Apple. Let's get back to AAPL. I think what you're going to see, a lot of chop. Eventually a trend's going to develop here in Apple. But it's not going to happen until we get some more choppiness within this range. Okay? So I think you're pretty safe selling down below 141 on the put side and above 156 basically on the call side. I think you're going to be safe, especially if you're looking at this front week. But further out, I do expect a trend. So I'm going to go back to what's been working, and you guys, it got a little hairy there with Amazon last week, right? Amazon on Friday opened at 10.12, got as low as 10.01, but closed at 10.20. So that got a little too close for comfort, right? Because weren't we 10.10 on the bottom end of the condor? But it still worked out. So we were very nervous about it. But this is the good news when you have just a couple, a few days, a handful of days after the earnings report into options expiration. And the other one was Google. We did a condor on Google. It was the same thing. It got a little hairy. Last trade here was 9.58. So it's funny how these prices end up working out and going according to what this options market was pricing in ahead of time. So let's move from the side-by-side view to the stacked view here. And the market was just pricing in about $5, okay? So the market's only pricing in a move to, 154, right? Well, $6 almost. So basically 155, right? Almost 155. And then on the downside, 143s. And we know by the chart, we already saw where the staunch support and resistance is here, okay? But this is what we can do let's say, and I'm just gonna tell you right now, I'm setting up a condor on this just to give you the pricing, so you can see. So going short a 155 call, gonna make 66 cents on that. Simultaneously going long the 157.50, you're gonna get 33 cents back. You're gonna have to pay 33 cents back. So 33 cents is the net credit. So on a bear credit, August 8th, August 4th, right? August 4th, 155, 157.50 call spread, 33 cent net credit. So we're going to keep that in mind. And now we're going to flip this to the put side and going out to those 143s. Sell the 143, and you can go all the way down to 140 if you like, or 141. We're just going to go to 141 here. And the math here, sell the 143 put, you're going to get 80 cents. Simultaneously going long the 141 put, to limit your downside risk, you're giving back 48 cents, so 32 cents is going to be the next credit. Net credit here. So here you've got a bull credit, August 4th, 143, 141, put spread, 32 cents. Okay, now here's the thing. So on the Condor, your net credit is going to be 65 cents, okay? Now, the amount of money you're going to have at risk is going to be the bigger of the two spreads. In this case, the 250 on the upside is the bigger spread. So take 250 minus that 65 cents. 185 is the max loss on the Condor. So the max loss on the Condor, 185. Because you're getting the net credit of 65 cents. Worst case scenario, it blows through the top end of your short call spread. You're going to lose $1.85. Because if you flip that to the downside, the most you can lose here is just $2. So if it breaks down, it's going to be $2 minus the 65 cents. You're going to lose $1.35 on the downside. But since I like to give you your risk versus reward in terms of the biggest max loss here, there you go. So we can make 35% here on the Condor, okay? On a few days sort of Condor here, okay? Now remember, so we would need Apple to close between 143 and 155 at option expiration for the max gain, okay? Now 143 and 155, let's go back to the chart and see what that looks like. Not Google, of course. So 143 is all the way down here. At 155 is up here. And the stock's at 148. So going back to this little curve I'm talking about, right? It's all crooked and sleepy, but that's okay. I'm basically taking the stance that it's not going to break out past here. Like, that's just not going to happen. But I don't want to take on the risk of a breakout to either side. Because the VIX is low. So I think maybe they're underpaying a little bit. And so I don't want to sell that. So I think there's a low probability of this breakout taking place. And I don't feel that I'm being properly compensated even for that low amount. So that's why I'm not selling at the money. Does that make sense? Trying to get behind kind of the logic and nitty-gritty thinking over here. Okay. So, hey, Miguel, you bring up a great point here. So if you think that they can break out to 155 if they beat and got great guidance, what you also have to consider is what the odds of that are, right? And if you feel this way, that there's no chance that they break down below 143, just do one end of this. So if that's how you feel, put on the bull credit. So that way you're going to sell an out-of-the-money put spread that's under that 143. So you get a directional bias to it. You just say, you know what? These guys, if it breaks down, yeah, August 4th. If it breaks down to here, I don't think there's any way it breaks down below that. All you have to do is half of it. So just sell the out-of-the-money put spread here, and that's the way you cash in, and you have a directional bias on it. The Condor, you're just kind of neutral. You're like, no, man, I just want it to bounce in between this range. I don't think it goes either way, okay? So there, I'm looking for kind of a quick turnaround on this thing, and that's what I feel is going to end up happening. So that's what I'm looking at, okay? Yes, August 4th. Now, what you can also do, if you're more bullish on Apple, this is to Miguel's point here. Instead of, so if you feel that this level is going to be like, doesn't matter, this is going to be defended, you can go further out and potentially make more money on it. So here I went out to August 18th. So just 2 more weeks, and we're going to look at the same spread. I'm going to look at this 143, 142 spread. 143, 141, okay? Now look at this. The 143 is 165. So selling the 143 is going to net you 165. Now simultaneously buy the 141 to protect your downside risk. It's going to cost you, oh wait, sorry guys. That's not one. It's this number. Sorry. 167 is what you're going to get for selling the 143 put. 120 is what it's going to cost you to buy the 141. So now your net credit here is going to be 47 cents. The difference in the strike prices is $2 minus the 47 is 153. So you can make 47 on 153. You can make 30% just on this leg. So if you have a directional bias here and say, no, I'm bullish, there's no way it breaks below 143, here's a nice way you can make 30% on that hunch in 2 weeks by selling the 143, 141 put spread. Now, I know what you guys are thinking. Well, could I do the same thing on the flip side with the calls? Absolutely you can. So you can do the same thing here, do the 155, 157.50. So here it's going to be 123 for selling the 155 call and 79 cents. So you're going to get 44 cents. Added to that 47 on the other side, here you can have 91. So by going 2 weeks further out, guys, you can add several percentage points to this. So you could potentially get 57% on an iron condor here, okay? If you go further out. So it adds a couple weeks, a little bit more time, and that's what you get. Okay? All right, so if you're currently long Apple, are you on the bullish side or the more bearish side? Now, if you're long Apple, you could do a lot of things, okay? One thing you could do is a protective collar. So we can sell an out of the money call. So essentially you're saying, okay guys, if it gets up here, you can go ahead and take my 100 shares, right? And using the proceeds from selling that call, you can buy yourself a protective put. So you can go, so look at this, 157.50, selling that's going to get you 79 cents. And if I buy the 138, it's 86 cents. I know it's close, right? So this is going to cost me $7 to protect myself on losses below 139. So you can always sell these calls out of the money and use that to buy a protective put to save yourself from disaster around these earnings, okay? So it's a way to definitely protect your holdings. That's one thing that you can do. And selling just these out of the money calls is like free money if you got 100 shares, right? You get $50 here, you get $120 here for just saying, okay, well, if it goes to 155, you're going to be happy anyway, right? So you're not only going to make the 123, you're also going to sell your shares at 155. You're going to make money. So heading into earnings, selling these covered calls is a good way to do it too. So are you bullish or on the bearish side if you're holding Apple? I think if you're holding it, you're long term. You're not so concerned with this earnings report. And over the long run, you are in fact bullish because you've seen this price consensus and EPS surprise chart. You know that we've got growth coming in 2018. The question is just, how are people going to react this earnings report to this? And I hope you guys know a lot when I'm making these earnings suggestions, these are earnings suggestions. That's it. There's been plenty of times, NVIDIA is a big one, where I'll come in and I'll say, this earnings report, I'm on the bearish side long term. I love this stock. So that's what you got to separate. It's sort of the short-term trade opportunity versus your long-term thesis on the stock. A lot of people have a long-term bullish thesis on Apple. Right now, looking at this, I think I am on that side too. Long-term bullish thesis on Apple here. Got another iPhone cycle coming out. Let's see what happens, okay? So there's there, all right? All right, guys. That's all I got on Apple today here. So I think the trade that pays is just doing the condor. Be on the credit side, out of the money if you want to be credit, go out of the money on either end of this, okay? And that's all I got. Unfortunately, I don't have time to open it up for a bunch of questions and stuff today. I'm sorry, guys. I have a lot of stuff. I got the Zach's Confidential today. Also got some other business I have to tend to, so it's a busy session for me. So I'll see you guys tomorrow. We're going to talk Tesla. It's going to be fantastic. Looking forward to it. Remember, you got the rest of the trading day today and tomorrow to go ahead and decide to do whatever it is you're doing. And that's all I got for you, man. So thanks everybody so much for coming out here today. I will see you all mañana. Have a good one.